Welcome back, everyone. Today I want to delve into the world of Entain. They used to be called GVC Holdings, and they got a wee bit of a rebrand there back in 2020. Now, of course, they are a major player in the gambling sphere and betting, and also a member of the FTSE 100, so they're definitely not a small fish, to say the least. So let's have a wee look through their website here. As part of the FTSE 100, they are one of the world's largest sports betting and gaming groups, operating an online and with retail stores as well. Some of their brands include iconics like Ladbrokes, Coral, BetMGM, bwin, Sportingbet, Eurobet, Party. Do you know what? They've actually a whole section on their website here, and we're going to just go over and have a look as well, so you can really understand exactly who they're dealing with. PartyPoker, Gala Bingo, a lot of us in the UK, you've seen the ads, you know Foxy Bingo, you've seen the ads for them as well. Coral's a big high street and online platform as well. Eurobet, judging by that wee logo at the side there, is a play on Coral itself. They've plenty more. Ninja Casino, a few other ones that I've never actually really heard of either. But yeah, a massive player in the space, to say the least. Now, on their website here, the most important part is, of course, the investors' relations. You can get news, sustainability, their foundation for good causes, because that's exactly what sport betting firms, need to involve themselves in, with good causes. Now, let's jump over here to simply Wall Street, where have a wee look at their stock. Ticker symbol ENT. They were last traded at £14.65. Now, they were about £3.63 at the drop. We'll actually see it later on. At COVID, they dropped almost £3.63 of that March. Of course, now rising to a high of almost £17. They're in fact down 15% over the last year. Market cap $8.6 billion. And we can see from their snowflake, they're a reasonable growth potential and fairly valued stock. 3 out of 6 in value, 4 out of 6 on future growth. Past performance not too bad. All right in the financials. Dividend, it does score 0 out of 6. It's a relatively low yield compared to especially some of their competitors like 888 Holdings, which I think has a much higher yield, although they've cut it for the last two. So that's something to bear in mind with these companies. Lots of growth potential, but again, definitely a bit of a red flag on their dividends at times. Trading at 16% below their estimated fair value, earnings are forecast to grow 44.16% per year. They have been growing nearly 46% for the last 5 years. Analysts in a good agreement that the stock will rise by 25.9%. Now, they do have a high level of debt, and we will be looking into that. Now, let's go on down. As I said, a few other competitors here. 888 Holdings would be one of the ones I would know a wee bit, or be more familiar with. And then there's also a lot of bigger players over in the US in this sort of world. Now, looking at their price history and performance, we can actually pull that out, and I can show you their all-time high was nearly about £23.77. You could have picked them up for as low as £3.24 back in March of 2020. Now, when we zoom back in, we can see expansion, debt financing, a few things on their dividend. They actually announced that they did issue their dividend, their 50 million, which equates to 8.5 pence per share. Okay. Bit of news, high number of directors, now undervalued 20%, a few other things. Let's go down to the company. Founded in 2004, it's a relatively young company. 23,390. The current CEO is Jet Nagard Anderson. I probably butchered that. I apologize, but my pronunciation isn't good at the best of times, but that threw me for sure. Down here on their PE ratio on the fundamental side, we can see they have a 40.4 times PE ratio. That is, it's quite massive, but their price to sales ratio is 2.1 times. So you can see that it's a pretty thin margin. I would have thought it was a higher profit margin, but it's only 5.14%. Gross margin is 81.81. Now that's massive, but again, net profit, there is a lot of other expenses that goes into these companies. I'd say a massive expense for the likes of these would be advertising. I would say without a doubt. Debt equity ratio is 72.7. We'll be looking at that later on. Now, their payout ratio is relatively low at only 23%. Yield, 1.2%, is also considered quite low, but with such a low payout, there is potential for growth in the future, provided all the other metrics line up. Valuation, well, we've already looked at PE. We can see against 888 Holdings, they're 11.4, although a much smaller company. White Bread is at 18.3. Let's go on down. The industry average is 11.4, so ENT is quite high in that regard. Who would be closer to that? Hollywood Bull Group and 888 Holdings. Well, Bull is certainly not on the gambling side of things if you would include bowling and mini golf as gambling. Now, their fair pay is actually 48.6, so they're trading a wee bit better than their fair ratio. When it comes to their fair value on a discounted cash flow model, we can see it's actually 15.7% undervalued, which, well, we know they did trade at one stage almost as high as £22, so they've traded definitely far higher than this. So that's a good indicator that they could potentially make £17.38 going in the later of the year. Again, it is a model. It's not something to be completely followed to the T. We'll be looking at another one, intrinsic value, later on in the video. Now, future growth, 44.2%. You can see that over the pandemic, well, even before the pandemic, 2019, earnings were not looking so hot. But from 2020, they rallied back, and as of June 2022, analysts are predicting that they're going to continue climbing on their earnings quite massively, actually, by 2025. Now, again, if it keeps up, that is going to be good news for their dividend. However, there is a lot of other things that you would have to speculate on. The industry as a whole is growing at 28.6%. That is hospitality, of course. Their industry is a bit more skewed than that. Let's go down to past performance, growing 46.1%. Wow, that's quite significant, actually. We can see back in 2016, things were not looking too hot, and the revenue from 2017 nearly tripled and has continued to do so, although earnings again being in the negative until 2020. Right. Down to financial health, we can see here that they are currently, they have 1.01 billion in short-term assets. That doesn't really cover their short-term liabilities nor long-term, but they have quite a substantial amount in long-term liabilities. Under their debt-to-equity ratio, though, we can see that they have an equity of 3.3 billion and debt of 2.4. When we include their cash and equivalents, the gap closes a little bit more, or extends a bit more, with 465 million in cash and equivalents. With their industry, they are definitely very good in the cash flow business. When it comes to their debt coverage, their debt's well covered at a 31.7% coverage, and interest payments at a 7.3 times. You can have a wee look at the composition of their balance sheet here. Alpha Spread has a slightly different way to look at it, which we'll be looking at soon. Dividend yield 1.16%. Whilst 1.16% is certainly not the highest yield, there is a wee bit more involved. Now, it is forecast to grow over the next 3 years, and it is a wee bit lower than the industry average. However, you can see that they had a yield of almost 4.4% and 5.3% back in 2019. Go even further, they were nearing 10% back in 2014-2015. So it is projected that they're going to do considerably well if all their other fundamentals do well into the future here. When it comes to earnings coverage and cash flow coverage, they are well covered. A lot of their earnings are retained and a lot of their cash flow is retained. For some people, that is a good thing looking at a company into the future. Management tenure is 3.8 years average, and their current CEO has been in the job for 3 years. As you can see, that she's served on quite a number of positions throughout. Whoa, that is a massive write-up. Wow, that's one of the larger write-ups I've ever seen. So let's see, served as a director, non-executive one, from 2019 to 2021. So she's been with the company longer than her 3 years as CEO, that's for sure. Now, let's go have a look at their leadership team. 3.8 years, so it's considered quite experienced. When it comes to the board, they're actually quite a wee bit younger at 2.3 years. It's not often you see that. So they're actually not considered experienced. But again, some of these positions may have moved around within the company, and that is something to always bear in mind. Now, when it comes to actually buying within the company, we can see here that there's been a few shares bought here and there, but nothing major or worth talking about. Institutions own 82.5%. The general public come in second with 17.4%. We can see here that Capital Research and Management Company own 15%. BlackRock, Dodge, Aberdeen and Vanguard and Sands Capital are a few of the other major players. The top 25 shareholders own a whopping 73.13% of the entire company. Now, jumping over to Alpha Spread, where we can have a look at their intrinsic value. Now, this is worked out with a discounted cash flow model we've seen earlier and a relative value model added together, and the average gives us a 22% undervaluation. Well, we know back in Simply Wall Street it was 17%. So again, just another model. You can go worst case, which it says it's 10% overvalued, and best case 55% undervalued, which is a bit crazy. But always recommend use multiple websites and to reach your own conclusion. It's always good to get a few models and so sometimes even the layout of things. On Alpha Spread here, you can see the way the financials are laid out. You can see the balance sheet composition, efficiencies, and other metrics that you may find useful. Links are all in the description. Now, another completely free resource to use is, of course, just Google Finance. Just simply Google Entain stock. You could even put just in ENT stock, and I'll bring you up this wee screen. You can play about with the chart here, and it gives you just a wee quick opening market cap, pay ratio, dividend yield. It is given a 0.58%, so some of the websites that do differ, depending on how up to date it is. I will certainly have it on the thumbnail, the most up to date as of today here on the 12th of January. And gives you a wee bit of the news. Very important to always follow the news on any stock just to see what is going on. They're actually headquartered in Douglas, Isle of Man. Wow, that's something I didn't notice. Nice. Okay. Dividend Max, our free website you can use for dividends especially. We can see here they've actually still got the old logo, GVC Holdings. Entain, I prefer the rebrand. It's quite nice. It's also nice and purple. We can see here from the dividend summary that they're expected to go X in 2 months. Now, that is the 16th of March 2023, so you would need to own the share on the 15th, provided they are indeed paying a dividend. We don't know as of yet. It is, of course, just forecasted. Forecasted actually at a 1.2%, so you can see it differs between Google, Simply Wall Street, Dividend Max. That's why I always recommend you check out several of them. And if you had 100 shares, you would have got a payment of £8.50 back there in August. Nice. And there's also the annual dividend chart that you can have a look. Now, they have at least paid dividends nearly every year, except over the pandemic. For a lot of companies, that can be excused. But of course, a lot of people, it is definitely a bit of a warning sign that if something, a world pandemic does occur, these companies do buckle under that, as a lot of their retail stores were shut down in that instance. Now, if you want to purchase Entain stocks, you can, of course, go to any of the free brokerages. The one I personally use is Trading 212 here, and as you can see from their chart, they're actually the highest they've been in at least the last year. So, since May of 2022. At £14.70. Also gives you a bit of information in the company. Again, all of the financials you can get. And for my case, I'm Trading 212. You can see their cash flow chart down here. And it is quite a useful thing. You can see that they're spending an awful amount of money on investing within the company, which is great to see. Sometimes that's a good thing when you retain a lot of cash flow. And with that, that has been Entain. Let me know what you think in the comments section below. Do you have any stocks of Entain in your portfolio? I would love a wee discussion on it. Thank you. I'll see you in the next one.